Welcome to the Economist in Your Ear podcast. As artificial intelligence surges, are we about to hit a financial wall, or is this simply the sound of a new economy being built? And crucially, as this transformation unfolds, who's really footing the bill? Today, we're exploring the financial landscape of the AI boom, drawing on recent insights from The Economist, and bringing in additional perspectives that add some crucial layers to the narrative. Our aim is to really go beyond the headlines and uncover the nuances of this monumental shift. So let's start with the sheer scale of the investment we're talking about. It's huge. The Economist points out that America's biggest tech companies are no longer just about software and, quick returns. They're combining Silicon Valley returns with Ruhr Valley balance sheets. Now that's quite an image.
It really is. And for listeners, think of the Ruhr Valley in Germany, historically. Heavy industry, factories, coal, massive tangible assets.
Right. So the analogy signifies this fundamental shift, doesn't it? Moving from nimble software firms to heavy industrial players.
Exactly. With all the capital intensity that implies. It's a fascinating image, and it points to a massive shift towards hard assets.
Yeah, and the numbers back that up. Firms like Alphabet, Meta, Microsoft, their property and equipment now make up over 60% of their equity book value.
60%. That's a huge leap from just...
On an Oracle from last year, it actually beats the total outlay of all America's listed industrial companies combined.
Wow. So it's not just growth. It's almost a redefinition of what a tech company is.
And the numbers supporting this shift are truly eye-opening, as you'd expect. This year alone, companies are expected to spend, $400 billion on AI infrastructure?
$400 billion, just this year.
And the predictions for the eventual total bill, they're just uniformly enormous.
Right.
Analysts at Morgan Stanley reckon we're looking at $2.9 trillion by the end of 2028.
Mm-hmm.
And McKinsey's consultants go even further, suggesting maybe $6.7 trillion by 2030.
$6.7 trillion. These aren't just big numbers. They represent an unprecedented reallocation of capital, really. And what's particularly compelling here, I think, is that these aren't just speculative forecasts. Independent evidence actually confirms this staggering scale and, in some cases even suggests it might be an underestimation.
Oh, really? Like what?
Well, for instance, Del Oro now projects that global data center capital expenditure, that's the money spent on physical stuff like buildings and equipment, it's going to grow by a 21% compound annual growth rate, CAGR.
21% year on year.
Yeah, topping $1 trillion annually by 2029.
$1 trillion a year.
And Synergy Research, they pegged cloud revenue at $98 billion in Q2 2025 alone, with a whopping $669 billion backlog.
$669 billion backlog.
Okay. And that backlog essentially locks in these multi-year build-outs. So it's not just money being talked about. These are commitments already in motion.
That insight into the locked-in nature is critical, I think. It's not some future, maybe. It's happening now. Now, this immense investment brings us directly to the Economist's core concern, this so-called financing gap.
Right.
For the first time, capital expenditure is growing faster than operating cash flows for these tech giants. Morgan Stanley calculates this could lead to a, $1.5 trillion gap over the next 3 years.
$1.5 trillion. That's significant.
It is. And this is where the story takes a fascinating turn because it signals a surprising shift in attitude towards debt from companies that have historically been extremely debt-averse.
Absolutely. They traditionally relied on equity or their own cash flows.
Exactly. And the article observes that the hot center of the AI boom is moving from stock markets to debt markets.
Indeed. And we're seeing this play out in very specific ways. Investment-grade borrowing by tech firms was, get this, 70% higher in the first half of this year compared to the first 6 months of 2024.
70% higher. Wow.
Yeah. Alphabet, for example, they returned to the bond market back in April for the first time since 2020. And Microsoft's finance leases, which are basically long-term rentals that function a lot like debt, often for data centers. They've nearly tripled since 2023, hitting $46 billion.
$46 billion, and that's not all of it, right?
No, there's another $93 billion of such liabilities not even on their balance sheets yet.
Okay, so this isn't just a minor adjustment. It's a significant change in how these giants are funding their expansion. And it's not just the established players turning to debt, is it? The challengers in the AI space are also borrowing furiously.
That's right. We're seeing companies like CoreWeave and FluidStack using chip-backed loans to finance their big NVIDIA chip purchases.
Chip-backed loans, interesting.
Yeah, using the chips themselves as collateral, essentially.
Mm-hmm.
Even SoftBank is reportedly financing its huge partnership with OpenAI using debt, And Elon Musk's XAI reportedly borrowing $12 billion just for chips.
$12 billion, after already raising $5 billion earlier this year?
Exactly. It really feels like everyone is scrambling to secure resources, and debt is rapidly becoming the primary fuel.
So this development naturally leads us to ask, what's the true nature of this new financial engineering?
Well, the market for debt securities backed by data centers where liabilities are pooled and sliced up, a bit like mortgage bonds, it's exploded from almost nothing back in 2018 to around $50 billion today.
$50 billion from almost nothing.
Yeah. And private credit lenders, including these financial giants like Apollo, Brookfield, Carlyle, they're stepping in aggressively. We hear Meta is even in talks to borrow around $30 billion from them.
$30 billion from private credit.
Which clearly shows this powerful convergence of the tech revolution with a financial one. Private equity firms are sort of refashioning themselves as major lenders to what's becoming the real economy.
Okay, so we've established the immense scale, the investment, and the surprising pivot to debt. But is that the whole story? While The Economist rightly highlights the financing gap, what other critical factors might be underplayed or entirely missed? It feels like there are bigger pieces to this puzzle beyond just the financial ledger, you know?
You're actually right. Beyond the sheer money, there are these often overlooked swing factors that are becoming increasingly dominant. Power, land, and carbon.
Ah, yes. Power, land, carbon. Let's start with power.
Okay, so for power specifically, the U.S. grid connection queues, that's the line projects wait in to get hooked up to the electrical grid, they already exceed double the current AI campus demand.
Double the current demand just in the queue. That's problematic.
It is. And what's fascinating here is that giants like Meta, Microsoft, Amazon, they've begun reviving dormant nuclear units through these 20-year power purchase agreements, PPAs.
Right, the PPAs, locking in long-term supply.
Exactly, allowing them to secure stable, carbon-free baseload power. But crucially, the costs for this power infrastructure often sit off the hyperscalers' books.
Off their books, so who pays?
They often fall instead on utilities and ultimately on ratepayers, you and me.
So it's a significant externalized cost that doesn't really show up in that core financing gap analysis.
Precisely. And then there's the issue of asset depreciation. This is a big one.
Right, because the article sometimes implies these are long-term, stable investments, like building a factory.
Exactly. But GPUs, the core processors for AI, they depreciate rapidly, typically within 24 to 36 months.
2 to 3 years.
Yeah. Morgan Stanley estimates that $1.6 trillion of that forecasted spend is on silicon that could be quickly leapfrogged by newer architectures. Think optical or in-memory computing.
$1.6 trillion on rapidly depreciating assets. It almost sounds like buying a top-of-the-line smartphone on a 15-year mortgage, knowing it'll be obsolete in 2 years.
That's not a bad analogy, actually.
Yeah.
And it raises a vital question. Are these debt structures, which often treat racks of equipment as 15-year assets, truly mismatched to the reality of rapid tech obsolescence?
That insight into depreciation really reshapes how we view these investments. It's definitely not like building a factory that lasts decades, is it? The Economist's narrative also tends to focus heavily on the U.S. Magnificent Seven tech companies. But if we zoom out, what does the global picture reveal? Who's footing this bill globally, and are their methods different?
Well, the global spending picture is much wider and, importantly, far more state-driven than you might think just reading about the U.S. giants.
Okay.
Asia-Pacific, for example, is actually set to overtake North America in new data center capacity by 2027.
Overtake North America? Where specifically?
We're seeing examples emerging in places like Johor in Malaysia and Gujarat in India. And these projects are often financed not just by corporate debt, but by sovereign wealth equity and loans from Japanese trading houses. So different funding sources.
Sovereign wealth funds, Japanese loans.
And China is another major player, naturally. They've issued $300 billion, that's about $41 billion, in innovation bonds this year, specifically for provincial AI clusters.
Innovation bonds?
Yeah, which effectively shifts part of the financial burden onto quasi-fiscal vehicles, sort of government-linked entities, rather than directly onto corporate balance sheets.
Yeah.
It really broadens the scope of financing.
That certainly changes the picture. Different players, different funding models globally. So let's reconsider the idea that big tech's fortress balance sheets are eroding. Is the picture really so dire for these titans, even with all this unprecedented spending?
Not necessarily, or at least maybe not as dire as it might sound initially. Even with this big ramp-up in capital expenditure, companies like Alphabet and Microsoft, they continue to operate at net cash positions.
Meaning more cash than debt.
Exactly.
Yes.
And they maintain sub-1x gross leverage, which is very low. Their interest coverage ratios, that's a measure of how easily they can pay interest on their debt, remain exceptionally strong. We're talking greater than 25x.
25 times coverage. Okay, that's healthy.
Very healthy. It makes them far safer and more resilient than, say, the telecom companies were during the dot-com bust back in 2000. Those companies were drowning in debt with much weaker cash flow.
Right, I remember that.
So while the spending is undeniably high, their underlying financial health seems pretty robust for now.
That's certainly reassuring for those specific companies, the big hyperscalers. But what about the broader market? Is there a risk that this massive capital expenditure could outrun actual demand? If consumers are slow to adopt AI or if enterprise adoption stalls?
It's a valid concern and definitely a crucial one to watch. However, the early revenue spike we're seeing isn't primarily coming from consumer apps just yet.
Okay, so where is it coming from?
It's largely in enterprise inference. That's AI services for businesses. Think cloud AI platforms. AWS, Azure, and GCP, the major cloud providers, they reported a combined $52 billion annualized GenAI backlog in Q2 2025 alone.
52 billion annualized backlog.
And that's up 240% year over year.
240% growth. Wow.
Which provides pretty significant near-term visibility on demand. It helps mitigate those concerns about immediate overbuilding, at least for now. The demand side, particularly from businesses, looks strong.
Okay. So if the hyperscalers themselves might be less exposed than initially thought, given their strong balance sheets and these clear demand signals, where does the real financial risk land in this massive AI infrastructure build-out? Who ultimately carries the downside risk?
That's the critical question, isn't it? While private credit is stepping in to fill that financing gap, it's certainly not a free lunch. Life insurers, for example, are often the end buyers of the highest rated, the AAA-rated data center asset-backed securities, or ABS.
Asset-backed securities, like the mortgage-backed securities we heard so much about before.
Similar concept, yes. Bonds backed by a pool of assets, in this case, the revenue streams from data centers. The concern is that a major shock, like a big jump in power prices or a prolonged plateau in AI demand, could potentially migrate that tech risk onto retirement portfolios.
Onto retirement portfolios.
Yeah, it echoes the telco fiber busts we saw back in 2002, where massive fiber optic investments went bust and hit bondholders hard.
That's a worrying parallel.
And regulators are already starting to scrutinize this. They're asking whether GPU-backed loans truly qualify as real asset exposure backed by tangible, stable assets, or if they're actually more like speculative tech risk.
That's a sobering connection you've drawn there, linking Silicon Valley innovation directly to potentially our grandparents' retirement savings.
So we have this tech revolution meeting a financial one, private equity firms becoming lenders. The underlying query then becomes, are these financial engineers truly understanding the very specific, very nuanced tech risks involved here, like that rapid GPU depreciation we talked about?
Well, to their credit, the emerging debt structures do attempt to mitigate this. It's not quite the Wild West of the dot-com era.
How so?
They often try to carve out the power and real estate cash flows into separate, safer tranches, which leaves the chip obsolescence risk, that fast appreciation risk, primarily with the equity holders, the ones who are supposed to take more risk. Ah, okay. So it's structured more carefully.
It's structured more like project finance, which is designed for large, long-term infrastructure projects with these kinds of segregated risks. It's generally seen as more robust than the sort of laissez-faire telco bonds of the dot-com era, which often offered little protection.
Okay.
However, the history of previous capital cycles, boom and bust, should still make lenders pretty cautious about the risks of overbuilding and falling returns. Regardless of how clever the financial engineering is, those fundamental economic pressures don't just disappear.
Right. So looking ahead then, say the next 12 to 18 months, what key signals should we and our listeners be watching, to understand how this story is truly unfolding and where these risks might actually start to bite?
There are a few critical watch points, I'd say. First, keep an eye on GPU supply elasticity. If the lead times for new chips, think NVIDIA's Blackwell or AMD's MI400, if those lead times normalize and supply catches up,
Prices could fall.
exactly, prices could fall, and that would immediately stress the collateral values for those chip-backed loan facilities.
Okay, GPU prices. What else?
Second, grid bottlenecks. This is a really big one. States like Virginia and Georgia have already paused new load approvals because their grids are strained. Further delays there could idle billions of dollars worth of dark data halls centers that are built but can't power up.
Billions sitting idle, that's significant.
Third, policy overhang. Think about export controls on advanced chips or potential carbon pricing. How might those shift capital expenditure geography almost overnight?
Geopolitics and regulation, always a factor.
And finally, the credit cycle turn. We're already seeing wider investment grade spreads adding, 60 to 80 basis points, that's 0.6 to 0.8 percentage points, to financing costs. A true recession would really test the resilience of that burgeoning asset-backed securities market for data centers.
Okay, so GPU supply, grid bottlenecks, policy shifts, and the credit cycle itself, lots to watch. So what does this all mean for you, the listener, trying to navigate this landscape of rapid change and, frankly, mind-boggling investment?
Well, I think the core takeaway is this. The AI infrastructure race is incredibly capital intensive, no doubt about it. But it's not necessarily balance sheet breaking for the hyperscalers themselves. The Microsofts, the Googles provided that power cost, the rapid amortization, and any regulatory costs land exactly where the financial models assume they will. That's a key assumption.
Right, a big if.
It is. The larger systemic risk, it seems, is that leveraged lenders like those private credit funds and perhaps utilities, rather than the tech giants' equity holders, are increasingly shouldering the downside risk of this enormous rapid build-out.
So this boon is undeniably fueling innovation, that's clear. But as we've explored, the question of who pays is far more complex than it appears on the surface. How cleverly the next few $1 trillion are sliced, wrapped, and rated. Well, that will determine whether the bust, if it comes, hits Silicon Valley's cutting edge or perhaps the quiet stability of retirees' annuity books. Something to mull over until our next conversation. Thank you for exploring the financial currents beneath the AI wave with us. We hope this exploration gives you a new perspective on the forces shaping our future. Join us again soon for another exploration of complex topics.